Just give me 1 second to get the link posted. And to change the title to 13 and 14. The title. All right. Okay, I just joined the Discord voice, and I have posted the link. So I'll go silent on Discord while people watch it on the link. Okay, so this live will be talking about chapters 13 and 14, which are trend line and trend channel lines. We kind of touched on it briefly last week with the pattern recognition or differences in pattern chapter, but we'll get into a little bit more specifics. So trend lines, it's like a lot for like such a simple thing, but I just wanted to be very clear. A trend line, so like a bull trend line connects swing lows, and a bear trend line connects swing highs. Everybody knows it, okay? When they're established, the most profitable trades are with trend trades, and you can always expect buyers below a bull trend line and expect sellers above a bear trend line. And one thing that people may overlook is when the trend line breaks. And when I say break, I don't mean, a wick below. I really mean a breakout and hold. Even if that breakout and hold is maybe reclaimed a few bars later by the previously prevailing side, it means that that side is losing or has lost control of the market. And after every trend line break, there will be a new swing to base a new line off of, which means that the trend is losing momentum and that side is losing control, kind of like what I was saying here. And let's get into the pictures. So obviously bear trend line, bull trend line. I won't harp on that too much. Again, everybody, at least in the room that this is for, is familiar with trend lines. But this might be a little bit different for some folks. So if you go back to this previous slide, every break there's a new swing to base a trend line off of, and even though one side breaks a trend line, it increases the chances of two-sided trading, and that side's losing control of the market, right? So this is Friday's action in the NASDAQ, and this first trend line, this very bottom one, you can draw after two touches, right? So you want at least two. You can draw all the way down, and we're just kind of following this trend. And here's a third touch, and it gets broken. And even though it was never retested, it has followed through. So it's a good bull breakout. But if you take the fact that just because this breaks, you could draw a new one on. So we have a new swing high to draw a bear trend line on. So we do 1, 2 touches, and the trend continues. And then you go to the next one, or this trend line still, third touch, it breaks, retests. The breakout is very poor, but eventually we can draw a new swing high, and you could have done it from here, you could have done it from there, you could have done it from there. The point is all of these are correct, right? But if you notice something, after the swing high is broken, you get a lot of trading range behavior. Even this bar, even though it's not very clear, but at the time, the bulls will want to test the 20 high and you get sellers. The bears are trying to close the gap, and then at bar 41 you get some buyers. So it's a little bit of trading range price action, just eventually the bears won. A little bit of climactic behavior here, but that's for later on in the book. The important thing is all these trend lines are right, and all the swing highs are being broken. All the not all the swing highs, but all the swings at the trend line are being broken. And the trend is getting flatter and flatter and flatter. So you have a likelihood, increasing likelihood of a trading range, which towards the end of the day we kind of got. So how to trade them? So trend lines often set up the most profitable trades being with trend, right? So what can you do? You can enter at a limit order, or you could take the first buy/sell signal. Because even if you're wrong, the likelihood of retesting that trend line and getting out with a small loss or break even is relatively high, above 60%. And what do you want to avoid? Well, if the market is consistently testing a trend line in a small amount of time, one of two things will likely happen. Market will break out or reverse rapidly. And you're like, well, duh, Victor, like, fucking, what a call. But because it's getting, you could say maybe to a tight trading range, or because the market is likely going to break out or reverse rapidly, it's going to do things really fast. In my opinion, it's best to be flat, because that could be a trade where you're caught off on the wrong side rather quickly. So, moving on to chapter 14, trend channel lines. A trend channel line is an opposite line of a trend line, right? So you have looking down here, we know it's a bull channel, but you could also call it a bull trend in some ways because you're making higher lows, right? Well, you put a line on the opposite side, relatively the same angle and same length, you're going to get a channel sometimes. Usually channels are formed from spike pullback channels, or spike in channels. And they're also trending trading ranges. Bull channels are more likely to break out down due to their bear flag nature on higher time frames, and the opposite is true for bear channels. They're more likely to break out up. It's not that they never, bull channels never break out to the upside, but more than likely they're going to break out to the downside. And again, same thing for the bears. So here you have a bear trend from the open. It's a spike, a pullback bar, and then you're channeling. And we channeled up, and you have a spike pullback, and we have a bear channel.
Can you hear me?
Yes, I can. I can hear you.
Oh, okay. I'm just running a few minutes behind with the setup of this cancel walk back.
Okay.
It's pouring fucking rain too. Makes setup a pain in the balls.
Hey, Rancid, I'm on YouTube.
Okay. I'll be there in 5 minutes.
Okay. Moving on to chapter 14, trend channel lines. The next slide. How do you trade them? Well, since channels are trading ranges, you should be counter trend trading at the edges. Obviously, you need to take quick profits. So this tool on NinjaTrader is a trend channel tool that I've adjusted to include a 50% line. You can do the same thing. So when I say, take quick profits, most at the middle, you can leave a runner for the edge test. Imagine that we're waiting for an overshoot, bar 16. We overshoot the low here of bar 15. You can set a limit order to buy, maybe at the trend line or a little bit below bar 15. And in the same bar, you get some of your scale, right? Or most of your scale. I just added that idea into my NinjaTrader, and I can show you how to do that if you want. If you're looking for a breakout, wait for 3 pushes minimum in either direction and play a breakout, retest, and hold. So this was from Thursday. You have 1, pullback 2, pullback 3 pushes. And then we begin to break down. Why 3? Well, the market tends to do things in threes. And you don't have to wait. It doesn't have to break out on the third push. We could channel for much longer. You could obviously wait for a strong breakout and sell a bar like 43 if you'd like. That's completely reasonable. And even on this side, you have 1, pullback 2, pullback 3 pushes down, and then we reverse up. What do you want to avoid? Trading in the middle and trading with trend setups, buying high, selling low, and to not anticipate the breakout. So, maybe you don't want to sell low and buy high, right? So you don't want to sell below 14, 15 here. And you don't want to buy above 20, 21 because the likelihood of you being trapped is very high because it's, even though the channel is trending, it's a trending trading range. So the trading range rules still apply. And if you're not good at trading ranges, then don't do it. You don't have to do it. Just because it's there doesn't mean you have to do it. And lastly, the words of wisdom from Al. A lot of these two chapters are very technical, so he's like really on topic, but I did like what he said here, and I'm going to paraphrase this essentially. He was talking about how beginner traders won't recognize this channel. Maybe they sell below bar 28, maybe they sell below bar 15, because all they see is, the potential. They see, or they want, a bar like 43, 44, 45, but they don't see that we're likely in a trading range, and most breakouts fail. 80% of breakouts fail. So all they're seeing is their reward, but they're forgetting the risk and the probability of success. The risk is high to sell low in a trading range. The risk is high to buy high in a trading range. The probability is low. So it's not good for your trader's equation. And you need all three to be evaluated before placing a trade. Okay, that is it. I don't see any questions in Discord, so I will hop on off and link it in the Discord. Thanks, guys.